So we'll start. Good afternoon. So we were discussing about portfolio risk and return. Right? And then we did the calculation to identify the portfolio risk and return. That part completed. Okay. And then, so we have a double summation approach and identify the way of calculating portfolio. Which one? Double summation approach is for what? To calculate portfolio. Double summation approach is for what? Risk calculation, portfolio risk calculation. So we identified covariance can be calculated in two different ways. What are those ways? First one, we have a law formula. The other one, what is it? With the help of correlation coefficient. So then the thing is, if you were given the correlation coefficient and then the individual stocks standard deviations, right? Rather than applying the covariance, what you can do? You can apply the second method to calculate the covariance in the double summation approach formula, right? Okay, then take down the heading, second method to calculate portfolio risk. Second method to calculate the portfolio risk. Second method to calculate the portfolio risk with correlation coefficient. With correlation coefficient. With correlation coefficient. Write down the basic formula to calculate the portfolio risk. What is the formula? How many components there? How many components? 3 components there. What are the 3 components? Weighted. Very simple. What those are? Weighted risk of the possessor, and then second one, weighted risk of the second as well, and third component, the relationship between among the returns of the particular shares. We call it as a weighted covariance, right? What here going to change is the covariance part, right? Rather than applying the covariance directly, you can rewrite the formula like this, right? Expected risk of portfolio equals first component weighted possessor risk. Then plus weighted second asset risk. Now third one, right? We have 2 shares. We have 2 shares and then we have 2 weights, weight on J and then weight on I multiplied by what was the statistical formula? Yeah, covariance, right? Covariance. But previous formula we have taken the covariance. My question is, if we do not have if the question itself not asking about the covariance, right? So then, and meanwhile, if you know the standard deviation of the two vessels, and then if you know the correlation coefficient, do we need to spend the time to calculate covariance with the log method? No, no point of view. So then what you can do is, rather than calculating this one with the log method, you just apply these three and then have the balance for the covariance. Right? How can we then? How can we? Standard deviation of the first asset multiplied by standard deviation of the second asset multiplied by correlation coefficient in between these two shafts or two assets. Are you clear what did I do? No, you were not clear because you were not there on that slide. Yes. Is that clear? No. No. Okay. මොකද්ද මේ කරේ? Look at here very carefully. To calculate the risk of portfolio, we can have two methods, right? Double summation method. Under that one, we can have the two formulas, right? First formula, you know the covariance. You know the covariance, right? But second formula, right? So in second incident, actually, we don't know the covariance. We don't know covariance, but we know standard deviation of asset number 1 and then standard deviation of asset number 2 as well as the other one, what is it? Correlation coefficient. Correlation coefficient. What do you mean by correlation coefficient? Correlation coefficient, directional relationship, and then strength of that directional relationship, right? And then covariance means covariance. You go to the note and tell me. Correlation coefficient. Tell me what do you mean by correlation coefficient? Directional relationship plus strength of the directional relationship. Covariance then? Only the directional relationship, whether it is positive, negative, or no. And that's what we are finding through the covariance. But correlation coefficient, extension measurement of the covariance, therefore it identifies strength as well as the direction both, right? In the first incident, right, you know the covariance. You have taken the long method to calculate the covariance. Okay, right. Then what the second scenario, since we know about the covariance, right, in the way of calculating the portfolio is, how can we? Weighted, star weighted on the first asset multiplied by the standard deviation of the first asset plus star weight on the second asset multiplied by the variance of the second asset. Variance of the second asset plus we have two shares. Accordingly, we have two weights. And then we apply covariance. We apply covariance. Is this a formula that we have written down yesterday? Yes. Now, we do not know the covariance. To calculate the covariance, we have to have a Lot of steps. So we have to have a 3 columns and then take the total one by one and then have to write it, right? We don't know now covariance, but rather than taking the covariance, we know this information, right? What now we can do is, we want to calculate the portfolio risk. We take it based on J and then variance of J plus add weight on I multiplied by variance of I plus we have now two shares multiplied by we have weight number. Weight on I, weight on J. But now we don't know covariance. But can be calculated via which one? Covariance equal. Go to the covariance formula. Lecture note. To calculate the covariance, there are two methods. What those two methods are? First one, sigma expected return minus average return multiplied by the probability. Right? That's the formula. And then second formula. What is second formula? Covariance equal. Covariance equal. What is it? Tell me. Standard deviation of the first asset multiplied by standard deviation of the second asset multiplied by correlation coefficient, right? Correlation coefficient in between the two assets. If we don't know what this one, what you can do? You can apply these set of things to have the various covariance figures. Right? So therefore, what you can do? No point of actually calculating the covariance with the long formula. We have the two methods. We have two formula. We have two standard deviations for the individual one. So that sometimes question will be given the correlation itself to you. So therefore, in that scenario, don't waste time for to calculate the covariance. No point of calculating it. So then, risk of the first asset multiplied by standard deviation on the risk of the second asset and then correlation coefficient, which gives what? Which gives the now hope it is clear. Are you clear now? Clear? Covariance එක හදලා මෙතන එකක් ගෙනල්ලා දානවා covariance වෙනුවට. Okay, you can write it down there. Okay, right. So then we'll go to the full practice question. You can read the LMS practice question. Last question. So this is what we have discussed. Another important point, right? Portfolio diversification impact, right? Portfolio diversification impact will be captured by correlation coefficient, right? With portfolio diversification impact means whether to have two investments in my portfolio is worthwhile or not, right? So previously I had one investment in whatever the place. Now rather than investing in a one share, now I have invested in two shares. Now you have to evaluate whether this is worthwhile or not, right? So we call this one as which one? Portfolio diversification impact. Did we diversify our investment by confirming or by forming a portfolio? Did we diversify our investment by forming a portfolio? Obviously, why not? Previously, we had only one investment. All the 100,000 put into the one share. But now what happened? I have selected two shares in two industries. First one, John Cales, and the second one, the Kingsbury might be, right? So then I have diversified my investment into two different investments. So now you have to identify, is this worthwhile decision, right? Is there any diversification impact of this portfolio, right? Rather than making an investment in holding a one particular share, which is sometimes it might be John Case. Rather than putting entire money in John Case, what is the impact of having the two different companies shares? We call it as a what? Diversification impact, right? Diversification impact can be captured by correlation coefficient metric, right? So we know correlation coefficient metrics vary from -1 to +1. Accordingly, we have three different stages. First one, perfectly positive. The other one, perfectly negative. The other one, zero. That means moderate, right? Moderate. Okay. So then if they are perfectly positive, what it means? Perfectly positive. Perfectly positive relationship between two stocks return. That means when the John Keel's return is increasing, what happened to the return of Galadario, the Kingsbury? It is increasing. Meanwhile, John Keel's decreases, Galadar decreases, right? Is that good scenario? Is that worthwhile to have a diversified? Is that if the returns are having that sort of a relationship, is that worthwhile to invest? Yes or no? No, right? Why? So while you are receiving the gains or while you are receiving the loss from one company, same loss is covered, same loss is occurred by the other company also. Why? When the sampati is decreasing, commission also decreasing. Even having two different classes of asset, both are having positive relationship, perfectly positive. Whether it is not creating a diversification impact. Clear? The other one, perfectly negative. What do you mean by perfectly negative? One particular share increases, return of the one particular share increases. What happens to the return of the other share? It's decreasing. Right? For example, when John Keel's share return is increasing, Galadari decreasing. Galadari increasing, Jones Keel's decreasing. Is it worthwhile to have that kind of a relationship? Yes or no? Perfectly negative. No or yes. Once you are receiving the yes, no. Why you are saying it no? Yes. Impact. Yeah, that once you are receiving the profit, you are having a loss. Right? That means if you are having that means when we are forming a portfolio, there might be diversification impact. Why? Even you are receiving a loss from the one, you might have the profit from the other one. So then what you can do? Your profit might be at least not a negative one, that might be zero. Whereas perfectly positive case, 50% negative, 50% decreasement, again 50% decreasement of the another company. What happened? Total 100 decrease. So that means perfectly positive, entirely not creating any diversification impact, whereas perfectly negative, that is creating a diversification impact. While when one company is decreasing return, the other company's return is increasing, means they are balancing this income versus or the profit and gain, profit or loss, at least to have a zero balance. So therefore we call it as if it is perfectly negative, there is a diversification impact, right? This is clear. එකකින් අඩු වෙනකොට තව එකකින් වැඩි වෙනවා. එතකොට කම්පැනි දෙක දාපු එක හොඳයි අපිට. එහෙම නැත්නම් කම්පැනි දෙකේම අඩු වෙනවනම් හම්බ වෙන loss එක ගොඩක් වැඩි. ඒ නිසා අපි කියනවා if it is a perfectly positive, perfectly negative, there is a diversification impact, right? The other one, what is the other one? Correlation coefficient is zero, means we can have a moderate level of diversification impact generated. We can't predict it, so therefore we call it as a moderate level diversification impact. So therefore, if any question asking about diversification impact, what you need to look at for correlation coefficient calculation. This one calculated yesterday. The answers. You can go to the practical question in the LMS. Read it. The word document is there, practical. There are two tutorials actually. First one is practical. Practice question and risk candidate tutorial. Start with the practice question. This covers A to Z. Right, A to Z. Even you are not participating in the last yesterday lecture, you can cover by doing this. Okay, try to do this one. This can be done entirely covering the portfolio theories. Fatima, you can capture the last yesterday lesson by doing this one. You can look in your pen. Also the same. How about your trip? How many kilometers? 6 kilometers. If you are going through the question that they have asked, that provide you the flow of the question. Right? The flow of the question. First question is regarding something which you need to calculate first. The second question is regarding the second step that you need to follow. So therefore, if you can't remember the order of this set of a question, just follow the order of the question. Okay, we'll read the question. An investor interest in investing 300,000, allocating 118 stock Gamma and then 120 in the stock of Lemma. Right now, highlight. If you have not, highlight 180 and 120. But it provides the information for. This is for what? Weights, right? Now, this is for weight. Mark it W, G, and the other one W, N. Weight. Or else at least mark here weight. Mark their weight. This is weight. We don't know still which weight. The possible return rates under different economic conditions were given to you. How many different economic conditions? We have boom and then stagnation, and then the third one, recovery, right? Probabilities 0.5, 0.2, 0.3, and then Gamma, we have two stocks, gamma and lemma. Annual rate of return also given to you. What is the first question asked? What are the expected return from gamma and lemma? That means that is the first step that you have to do. Expected returns. And then which stock do you think have a high risk? That means you have to calculate which one? Standard deviation. First one, you have to calculate the expected return. Expected return, ER. Now, third question, if the investor build a portfolio, what will be the expected return of the portfolio? Write it there. Expected return of portfolio. Calculate covariance. COV. COV. Calculate COV in between N and G, lemma and gamma. And then last one, calculate the portfolio risk. That means standard deviation of the portfolio. Last one, it is about the diversification impact. Okay, try to do it by your own, by discussing with your friends. Try to do it. There is from the expected return. You take the return as a percentage. 0.1 means that is 10%. Can't see the board. Yes, you can. You can't, if you do not have any notes, you can refer to given returns and probabilities. How can you take the weights? If you want to calculate the expected return of the portfolio, you should have an idea on weight. How can you take the weight? You have how much? You have 300 grams. Out of that one, 180 goes to G and then 120 goes to other one, then. So then 180 divided by 30, that is the weight for G. 120 divided by 300, that is the weight for the N. Yeah, exactly. If you are, for example, if you are coming to this question as a last question, even the question number 2 is asking about the standard deviation, you can quickly learn portfolio risk marks. Why? Once you calculate the individual stock returns, directly applying the weights, you can go to the portfolio return calculation rather than doing the standard deviation calculation. Refer your note and take your time and do it. And practice the entire flow. If you have questions, you can let me know. One completed. Second lesson printed is how much? 0 point. This is actually 3.7. And then this is 9.5. Why? The decimal decimals gන්න එපා. Decimals ගත්ත ගමන් මොකද වෙන්නේ? දෙකම decimal ගත්ත ගමන් 100 වලින් answer එක වැඩි කරා. එකක් decimal වලින් ගත්තා නම් හරි. මේ answer එක වැඩි කරා. මේ answer එක වැඩි කරා. අතු ඉන්න බෑ කවදා. මේක තමයි කරනවා මේක තුනක් මාත්. decimal යනවා අමාරු වෙන. මේක කොට ටික මෙසියට කොට හරයට මේ හරයි. Sila Visai and Namayan Hemda. This is our fighting license. See, medical and only get a quality. Second lesson return is 0.095. Am I correct? If you are going to same answer, expected return for the lemma is 9.5. Okay. Yes. Hold on, be sharp, but my bag. Let's see. It is. It's going to be turning into a portfolio. Yeah. 0.6 and 0.8. Okay. Can anyone tell me the risk of the gamma? Tell me the risk of the gamma. Okay. So, risk for the gamma? And for the gamma. At least variance for the gamma. Adjustment. Adjustment. Sure. What is your? Tell me the variance for the gamma. Variance for the gamma. Adjustment. What I have. Sure. 10.89. Oh, take a course. Yeah, my choice is great. इसके कबाला ने सलाम हर देखिए तब बात नहीं होगी बात करते हैं बात होता है أهم شيء كل هذا الشيء إكمال بيسكل بيجي زي ما كنا بندرسه بينو إكتاكا إكمال ما بيتين كله إكمال هنقول square root of the variance standard deviation again there are many balloons may I explain may teacher that's me expression मैं आगे मतलब विंडो एक साइड पे हटा हटा But can quality sanitization again? Okay. And you are okay. You have to check your answer. Huh? Okay, you know it. You will continue it. Okay, variance should be 0.01322. Around. It should be, that means if it is around 14, that is correct. Huh? Then risk is 11.5 for the first one and the other one 8.8. Check whether you have received same answers. Variance is 0.11 and the other one 0. Yeah, the other one 0.007825, around something. Then there might be some differences. But this is same thing. Can we do it then? The first one, variance should be 0.01322. It was. Your answer also this? Okay, what do you call it? Ishara, you can give me the answers. For the variance, how much is the variance? 0.014. 14, eh? 14, that's correct. 14, that means around. I have taken it for the 3 decimals, so therefore it comes as 0.0133. That means around 40. Right? That's correct. And the other one, it should be 0.0078. Okay, no? That is correct. It should be changed. 0.0. Anyway. We have to have the first one. First column should be the states. We have 3. Then probabilities. Probability for the first one, that is 0.523. 5, 2, 3. Then we have returns. 2 returns. 0.1, 0.2, and the other one 0.09. Is this correct? So then the other one 0.15, 0.08, and then 0.13. Tell me the expected returns. Expected return of G. How much is it? How can we calculate? 0.5 multiplied by 0.1 plus 0.2 multiplied by 0.2 plus 0.3 multiplied by 0.09. The answer is how much? 0.037. That means 3.7. So the second one, expected return of the other asset, that is, what is the asset? N. And then again it should be 0.5 multiplied by 0.15 plus 0.2 multiplied by minus 0.08, good, and then plus 0.3 multiplied by 0.12. The answer is 0.095. That means 9. Hope you have calculated up to this point, and then the answers are correct. Fatima, okay? Okay, then we'll go to the standard deviation calculation, which is very important. First, what you need to take? First difference, and then first difference of the other asset, scared differences for the other asset, and then with the probabilities. Right? So then we need how many columns? We need 6 columns. First one, return of G minus return of G minus expected return of G. Then the other one, return of G minus expected return of G, and then it should be, yeah. Then apply the probabilities. Probability multiplied by return of G minus expected return of G to the start balance. Then return of N minus expected return of n. It should be n. Then return of n minus expected return of n star. Then applying the probabilities. Probability to the return of n minus expected return of n scarce balances. Right, so this is the way. We'll take first difference. What is the first difference? Tell me. How much is the first difference? 0.063. Am I correct? 63. And then minus 0.237. Third one minus 0.005. Correct? Minus 1.
Zero point zero 53. Zero point zero 0.09 0.037 0.09
0.9 minus 0.37. Next. Okay. What's the answer there?
0.053.
0.053. Second one. 0.055. Is this correct? Then second one 0.
Minus
0.175. Third one
0.02.
0.025. Then start balances 0.00396. And then 0.056. 0.056. Then 0.02. 0.002. Is that correct? 2.8. Then the other one 0.0030. Next. Then 0.00360. 306. Then the other one 0.00625. 0.00625. Okay.
0.003. Triple zero.
000 625.
Okay.
Yes. 000 625. 000
625.
625. Now the scalar probability levels. Now that is 14. The variance is coming as 14. And then probabilities, applying the probabilities. Fatima, tell me the balance there. 0.0019. Am I correct? 0.00198. Okay. Then 0. 0.011 2 3 2 3 2 3 or 2 4. Third one 0.00008 4 2 7. 0.000842. Okay. Then we'll move to the asset N. 0.0015. Am I correct? Correct? Then 0.00615. Last one 0.00018. 01875. Now take the total. Take the total. Total is for the asset G, that is 0.014. Zero 61. The other one 0.00785. Have you all got the same answers? Check whether you have got the same answers. This is what is called as variance. Variance for G. This is variance for N. Now to take the standard deviation. Variance now. Then we can calculate the standard deviation. Standard deviation is very important. Standard deviation of G. And then standard deviation of N. How can we? Square root of 0.014061 and the other one square root of 0.007825. What are the answers? 11.85 and the other one 8.84. Check whether you have got the same answers. Rakshita. Okay. Standard deviation 11.85 and the other one 8.84. Then you can do it, the remaining part. Standard deviation found means very easy to go with the portfolio risk and return. Expected risk of the portfolio and diversification income. Diversification income is a calculated and the number $100. Then you have calculated the correlation. You have covariance. Then you are dividing the variance by two stocks. Then identify whether it is +1, -1 to the moderate. Steps 12. Nice grab, but it's a release grab. Place. How the way. Okay, so I'm going to take care. Four variants. Four variants. Four variants is how much? Four variants. Four variants 0.01042. Apply that. Left and right. Even they also you can change the place now. Okay, that's good. This of the code for 10.64. Sure. Risk of the portfolio 10.10.41. 10.41. How about the diversification impact? Have you calculated diversification impact? How can we calculate diversification impact? No. Covariance divided by the individual stocks. Remember, covariance divided by the risk of the first asset multiplied by the risk of the second asset. So then you identify whether it is +1 or -1 and then write it down how sort of the diversification impact is there. But that's a this is very it's minus +1, right? So they are minus 0.27. We are calculating for covariance. What is first row balance? Can anyone tell me? For the covariance, first row asset, first row balance. Already here. Covariance, first row total. 0.00732. 1732. And then 0.008229. So it's 1. 0. Right? Now flow is clear, right? So then shall we do another question? Quickly do. Then you can do the third question number 2 as a homework. You need break? Do you need a break? For 5 minutes? What is it? No. Only. Okay, you can just have a 5 minutes break. Just have a drink. If you want to go washroom, quickly go washroom and come. You can need to do the question number 2 at home. Huh? Same flow. Same flow. Question number 2 you do at the home as a homework. Now it is 15, so then you can just have a brain practice. The last part of the lesson. So we know it's action. So by forming a portfolio, can you have the zeros? Can you have a zero list? No, you can't. Right? So then it's because of the systematic step. It is because actually systematic. So then race can be divided into two, where we call it as a systematic risk. The other one is the unsystematic risk. Right? So that is why, since there are some risk type, different type of risk, even we form a portfolio, you can't mitigate the portfolio risk to zero, right? So what are these two type of risk? Systematic versus the other one, unsystematic risk. Systematic risk means actually it is being called as a non-diversifiable risk, or else that is the risk arises because of the macroeconomic factors, right? So what are the macroeconomic factors in a country? Changes of the inflation, right? World price changes, industry factors, and then what else? Unemployment, GDP, right? All these are what interest rates, especially, and then world economic conditions and all the things. Because of these conditions, actually, those are impacting for the share prices to change. We call that one as a yield play. That's like that. We have a lot of risk coming from the macroeconomic side. Therefore, even we segregate our investment into 1,000 shares, such as Lanka and all the people, even they also can't have the zero portfolio risk because of these macroeconomic factors. I have made the investment in John case, and then another investment I did in the Cargill's Bank, and then another investment it in the Sampak Bank. Three different categories. First one retail, and the second one the Sampak Bank, the bank side, and then the other one, the Cargill's means again retail sector, right? Then even I have invested in three different places, inflation coming as the same to these industries. It's same. Unemployment same. Therefore, even we increase the number of units, number of stocks in our portfolio, we can't diversify the portfolio risk. So therefore, we call this one as again non-diversifiable risk for the portfolios, right? So this is because of which factors? Macroeconomic factors such as inflation and all, and then this is non-diversifiable risk. The other risk is diversifiable risk, or we call it as a which one? Unsystematic risk. So an unsystematic risk occurred because of the industry, not industry specific, organization specific factors. What are the organization specific factors? Organization specific factors which are causing for some sort of a risk. What might be those factors which are leading for a risk? There might be some management issues within the company. Is that a industry specific or the macroeconomic specific or the company itself having a sort of issue? Company itself having sort of an issue. Just imagine there are two competitors at campus and then the other one, ABC company, ABC campus. So then if the ABC company is having some sort of a management, what you can do is you can omit the investment in ABC and then you can put all money in the SAP campus. Why? SAP doesn't have any internal issues. This for example. Right? Other one, if you have identified the company Sampak Bank, now recently they have received the loss for the 5 months, last 5 months. So then you have another bank. So then what you can do, even if you have the investment in Sampak Bank, you can withdraw your investment and then put into another bank, or else you can keep the small amount at the Sampak, and then what you can do, rather than investing in a Sampak Bank, you have invested in different places, right? But then you have the so since there are some microeconomic factors within the company, or else the organization factors, again by company also facing some sort of a risk, as well as the investors. So as an investor, can you mitigate that microeconomic factors? Obviously, microeconomic factors can be why if there are internal issues, if they do not have materials, if they do not have enough labor, if they do not have other capacities and all the things. Once you got to know that the particular organization having some sort of issue, what you are doing is as an investor, you are withdrawing your funds or you keep that small amount of money there and then you are trying to make the complex investment, right? Rather than investing one company or two companies, now you are trying to move forward with the 2-3 companies. So then what happened there? Your risk is, what happened to your risk? Yes, risk is divided among now 4 different companies. That means you can mitigate your risk by forming a portfolio. So then other way around, then therefore we call that sort of a risk which is occurred by the microeconomic factors. We call it as a which risk? Unsystematic risk. Unsystematic risk can be passed by forming a portfolio. Whereas even you increase the number of assets in a portfolio, you can't mitigate the systematic risk. But if by increasing the number of amounts, number of stocks in your portfolio, you can mitigate the unsystematic risk. So then we call the unsystematic risk as which risk? Diversifiable risk. Clear? Total risk equal the, if you want, you can write it down. Total risk equal the systematic risk and then the unsystematic risk. So again, if we graphically illustrate this one, this side number of stocks in the portfolio and this side portfolio risk. We know portfolio risk is equal systematic risk. Systematic risk, the other one plus unsystematic risk. Unsystematic. So even you increase the number of stocks in your portfolio, 2 to 3, 3 to 4, 3 to 4, again 2 to 3, 1 to 1, 1 to 2, and likewise, you can see that systematic risk is constant at every point. Right? Systematic risk means because of the macroeconomic factors. Macroeconomic factors risk because of the macroeconomic. Whereas you can identify here now unsystematic risk. If you have a one portfolio, you have a high unsystematic risk. But if you are moving towards the diversification by including several stocks in your portfolio, definitely your unsystematic risk is going down further, but it's never recorded as a zero. That is why even for the portfolios also has some sort of a risk because of these two risk factors. So this is unsystematic risk because of the microeconomic factors. Microeconomic factors, or the we can call it especially the organizational factors. Organizational factors. Company specific factors which are giving us risk for the portfolio. Macroeconomic factors and then the organizational specific factors. If you are confusing about the microeconomic factors, just write it down. Organizational specific factors. This is undiversifiable, but this is diversifiable. Macroeconomic factors leading for the systematic risk, and then organizational factors leading for the unsystematic risk. Unsystematic risk can't be diversified. Unsystematic risk can be diversified. Can diversify, but systematic risk can't diversify. Can't diversify. This can't diversify. Okay. Now you can take down the heading Capital Asset Pricing Model. Last concept of our lesson, Capital Asset Pricing Model. Hope you remember, we have calculated return. We have calculated return. Return for what? Return for what? We have calculated return for what? Return for a share, right? We have calculated return for a share. Based on which data? Based on historical data. And then based on, we have calculated return based on historical data. And then we have calculated return based on the forecasted data. If the return calculated based on the historical data, how did we calculate the return? Average return, did you remember? Total return divided by the number of years. But for the forecasted data, how did we calculate the return? Probabilities multiplied by the total of probabilities multiplied by the expected return. But we have another model, right? Actually, the model to identify the expected return of the investment. Here we can use it for a portfolio as well. Right? We'll just consider it as a return for a share by using capital asset pricing model. Right? We have calculated return for a share based on historical values and then the forecasted data. Now we are going to identify how can we calculate the return for a share based on the capital asset pricing model. CAPM means capital asset pricing model. So this is actually the entire, it's not a, we can't identify within 10 weeks and 15 days. It's having a, so this is actually a model where we have to in deeply discuss, but here we do not have the time to discuss in detail. So then just we'll go through the formula, the way of identifying the return for a, return for a share, right? So this says at least, right? At least if you are a shareholder, company have to provide them a return more than risk-free return rate. What do you mean by risk-free return rate? When we are discussing about the risk-return relationship, we have identified the default, even the default risk is zero, some sort of a pressure, some sort of securities are giving some sort of a return. But those of securities are treasury bills and then the treasury bonds, right? So even the default risk, zero level of risk, but the treasury bills and treasury bonds are giving some sort of a return for the investor, right? So we know if as a company, if we are providing return similar to the treasury bills and treasury bonds, can you attract the potential investors for your company? No, you can't. Why? You are giving the entitlement of the ordinary shares for the potential investors. If it is ordinary share, definitely there is a risk. So then, rather than invest in your company, investors are trying to move forward with the treasury bills and treasury bonds since the treasury bills and treasury bond have a zero level of a default risk. So therefore, this model says minimally, right? You have to give how much? The risk-free return for your shareholder. That is also not enough, right? So then you have to identify which one. You have to identify which one. Risk premium, right? This is risk-free return plus as a company, you have to give something premium. You have to give a premium for the investor. So therefore, we call this one as what? Right? Risk premium. See here, individual stocks require rate of return equal to what? Require rate of return equals to risk-free rate plus premium for bearing systematic risk, right? That is why I have discussed here the previous slide, systematic risk. Then we look at the other formula. This is one. This is risk-free return, and then this is one risk premium. What do you mean by premium? Premium for bearing which risk? Systematic risk. Why? Why should we give a risk premium for bearing systematic risk? Why? If you are investing in treasury bills and treasury bonds, do you have a risk? Do you have a macroeconomic factors risk? If we are investing in treasury bills and treasury bonds, actually not that much impacting for the treasury bills and treasury bonds. But if you are investing in a normal company, definitely you are impacted by the systematic risk. So then you have to give something return for them. We call it as a what? That is the risk premium for what? Bearing the systematic risk. Ordinary shareholders. So then how can we calculate the systematic risk? Risk premium for systematic risk. So you have to identify market risk premium. This part we call as a market risk premium. How can we calculate this market risk premium? So this is, we know, 10% of treasury bill securities return. But within the industry, we can identify, if you go to the Colombo Stock Exchange, S&P and all the things, they are mentioning that if it is a market or the industry specific investment, what sort of return rate you have to provide. Right? So then you have to identify which one. Expected return for the overall market. Right? Within the share market, how much of overall rate of return you can have by the making the investment. So this is the treasury bills and treasury bonds return, and this is the overall market return rate. So then you have to consider how much is the market risk premium. How much is the market risk premium? Rather than making the investment in treasury bills and treasury bonds, if you move forward with the Colombo Stock Exchange or the industry, company organized industries, how much of premium you can have. Is that clear to you all? Share market return treasury bills and this is what? This is your risk premium. Right? Risk premium. Okay, then you can have that amount entirely. No, you can't. Why? You have to adjust which one? We call the beta measured systematic risk. Systematic risk of that share. Systematic risk of the share. Right? That means systematic risk of the share means what? By calculating the beta, right, investors can identify how much of risk they face by the SAT campus, by the systematic risk factors. We call that one as which one? Systematic risk, that is beta of I asset or I stock. So then after you identify the market risk premium adjusted with the beta, that part needed to be added for the risk premium where it decide the expected return of the asset I. Right? So this is adding a lot of graphs and all things. Just focusing. What do you mean by the capital asset pricing model? It says that what it says, as a company, you have to provide minimally risk-free return rate, right? Minimum, not only that, right? So you have to identify, right? You have to identify risk of a market portfolio as well as the difference between risk-free rate. We call it as a market risk premium. Market risk premium. Market risk premium that the particular investor should have when they are coming to the stock market, but it is not entirely the profit of the company because company is also having something of the systematic risk. Beta I means I stock systematic risk. Have to adjust. So then this entire part we call it as a beta adjusted market risk premium. Beta adjusted market risk premium. We call this entire section as risk premium. Risk premium. Risk premium for bearing systematic risk. So this is how CAPM model decide the expected return of the I share. Right? Expected return of the I share. You have to very clearly understand. This is the stock I and this is the what? This is again, I will write it there. Systematic risk. Systematic risk of stock market. Stock market. Systematic risk of stock I. Here it's given there how can we calculate the systematic risk of the asset I. How can we calculate it? Below it writing down the way of calculating it. How can we? Covariance between two assets. Covariance between, just will take I and J. Covariance between I and J. Covariance between I and J divided by, right, the other asset in the portfolio or the other asset that is J, then variance of J. Variance of J. Variance of J. Variance of J, and it should be variance. It should be variance. Variance of J. If we are finding the beta of I, right, covariance among I and J should be divided by variance of the other assets, that is 2. So just quickly read the exam, read the given question there. Don't need to calculate it, just read it. Suppose that expected return of a treasury security is 8%. Treasury security return, what is that? As per the model, that is risk-free securities return. Therefore, RFP is 0.08. Expected return on the market portfolio is 13. If you have a market investment, that gives us a 13% RN, return of the market portfolio. And then beta Sage company. Beta means the systematic risk faced by the Sage. How much is it? That is 1.3. Right? 1.3. And then you have to find what? You have to find the required rate of return for the investors who are investing in Sage. Right? So you have given there, how can we calculate? Expected return of a Sage equals risk-free return rate plus beta of S multiplied by expected return of the marketable security minus risk-free return. Risk-free return is 0.08. Beta of the S, that is 1.3. You have to multiply 0.13, that is the market portfolio return, and then 0.08, that is risk-free return. Altogether, the answer is 14.5. When you are calculating this sort of a question, first do this part. Right? In that also, you have to identify first this part, difference, and then multiply it with the 1.5, and then take the whole. So this is the way of doing it. Otherwise, don't take 0.81 plus 13 and then don't multiply it with the difference, right? So this is the one part. So this is how can we go in deeply regarding the A to Z, starting from the return and risk, and as well as capital asset pricing model, right? So as per your syllabus. Any question, any doubts? Is that clear? Last part, is that clear, Sul? Can. මෙතන question එකේ අයි දාන්න කියලා කියන්නේ
either question beta right
බීටා අයි නෙමෙයි ඇත්තටම වෙන්න ඕනේ මොකද කම්පැනි එක මොකද්ද සේෂ් නේ එතකොට මෙයා මේ කියන්නේ කවුද මේකේ systematic risk කාගේ systematic risk අපි ඉන්වෙස්ට් කරන්න යන්නේ නේද එහෙනම් එයාගේ එතන ඇත්තටම වෙන මම එක හිතන්නේ එතන වෙන්න ඕනේ මොකද systematic risk of beta S. එතන සැප් එකට ඉන්ෆ්ලේෂන් වලින් එන රිස්ක් එක මොකක්ද? ඒක වෙනස්නේ. අපි ඉස්සෙල්ලා ගත්තාම ඉස්සරහම දැන් ABC කියන NSBM එකේ රිස්ක් එක වෙනස්. සම්පත් බැංකුවේ සිස්ටමැටික් රිස්ක් එක වෙනස්. කමර්ෂල් බැංකුවේ සිස්ටමැටික් රිස්ක් එක වෙනස්. එතකොට මේ බීටා කියන එක වෙනස් වෙනවා. In our example, that is beta of the systematic risk on the I company. Here this is beta of the Sage. If the question is regarding the Sampat Bank, beta of the Sampat Bank. But this one, this free return and this one, that's okay, that's same. And then market risk also the same, doesn't change. Clear? It's between market attendance.